was saying, so this is the sort of second day of our Round the World webinar series, which looks at the Americas. We are very fortunate to have a high quality panel here today to sort of give us their views and answer some of your questions. So joining us are Dean Orrico, Manager of Middlefield Canadian Income, Jerry Polacek, Manager of Ecofin US Renewables Infrastructure, Tiago Rodrigues, Manager of Aberdeen Latin American Income Fund, and we also have Kamal Warraich, who is an investment analyst at Canaccord Genuity Wealth Management, who will be able to give us sort of their perspective as another asset allocator. I think this is a very interesting time for us to be running this Round the World series. Events in Ukraine and to Eastern Europe are impacting the global economy and financial markets, and it's just difficult to know where all of this is going to work out. And obviously this generates a lot of short-term uncertainty, and I think it's really easy to sort of lose track of perhaps what the long-term sort of opportunities and sort of stories are. But there are questions now, sort of what is the inflation outlook? What's going to happen to energy prices? Is this going to sort of put parts of the global economy into sort of recession? And these are questions that investors are now asking. And as I say, I think with all of that, it is easy to forget that there are actually really good long-term structural growth opportunities, or if we have more persistent inflation, that there are really good inflation protected income opportunities out there. And I think it's just a really good time to actually be sort of looking at all of these areas. However, I think to sort of kick things off, perhaps let's just sort of address the elephant in the room, as it were. And I just sort of wanted to ask the sort of panelists how they think events in sort of Russia and Ukraine might impact their particular investment universes. Perhaps we could sort of start with Tiago for that one.
Sure, and thanks for the invite. It's a pleasure. It's a pleasure to be here. So on the events in Ukraine, our view is that the war in the region is very fluid, and we are monitoring it closely. We have the benefit at the Latin American Income Fund to be part of a global emerging markets equity team, and this team has some direct exposure in Russia. So we benefit from direct input and insight from the team, we are monitoring the situation closely. Things are changing very rapidly, with no precedent and the speed that sanctions have been applied to Russia. And this certainly has an impact. This will certainly have a very high impact on Russia and in the global economy in general. We see the LATAM region as naturally insulated from these types of geopolitical tensions, but we remain vigilant on the potential impact in terms of supply chain shocks and how that will impact global growth, inflation, and interest rates. But we do believe that the LATAM region benefits from being relatively insulated from these geotensions. And in fact, we've been monitoring some recent inflows into the region, which we believe is some sort of reallocation within EMs, benefiting LATAM equities, since they're deemed as safe, at least when in terms of conflict risks.
Super, thank you. I mean, if I sort of look at the Canadian market, Dean, I sort of tend to think obviously a lot of resources, potentially sort of stocks that would potentially benefit from a hike in energy prices. I mean, how do you think this is affecting your universe?
Yeah, thanks for having us today. And while the events underway in Ukraine are certainly terrifying and horrible, and we certainly feel for the people of Ukraine, as far as the Canadian investment landscape goes, we think similarly we're fairly well positioned. Our trade with Russia, Ukraine is very minimal. We are a country that is abundant in resources. And when you think about the impact on oil and gas prices, that is clearly benefiting Canadian businesses that are leveraged to the energy market. So in our portfolio, for example, our single largest weighting is Canadian natural resources, and it's performed very well in terms of price performance. And just this morning, it increased its dividend by 28%. On the heels of a 25% increase in its dividend in Q3 of 2021. So, this is a sector that will benefit from these tensions and the impact it's having on oil and gas prices. But I would also say that given the backdrop of already high inflation, it's high in Canada, not as high as we're seeing in the US. Clearly you're going to see a movement in interest rates. So the other major part of the Canadian market is our financial sector, which represents over 30% of the Canadian equity market. And those banks are performing in Canada extremely, extremely well. They just reported Q1 numbers that are showing very high capital ratios, very low payout ratios. Every one of our big six banks in Canada at the end of their fiscal year 21, so in November, announced dividend increases between 10 and 25%. We've got two banks now, TD and Bank of Montreal, both of whom are significant core holdings in our portfolio, who have announced major acquisitions in the US. So we think in light of this backdrop with higher energy prices, with increasing interest rates, really benefiting more cyclically oriented sectors that we really have here in Canada and are major weightings within MCT's portfolio.
Super, thank you. Jerry, do you think this will perhaps benefit you in terms of, lifting energy prices, and if obviously electricity prices are higher, will that allow more to fall through to your bottom line?
Yeah, Matthew, good question. And I'll phrase this from the perspective of the fund that I manage, Ecofin US Renewables Infrastructure Trust. The ticker is Renew. It's invested predominantly in US wind and solar assets that sell power under long-term contracts, revenue contracts with investment grade counterparties. So we have exposure to schools, universities, large utilities, and other corporates in the US. And so as it relates to the current uncertainty, given the conflict, it's a very defensive and very uncorrelated to the volatility that's in the market. As you think about rising natural gas prices and energy prices, the fuel for our fleet is free. It's the wind and solar. So net on a long-term basis, as we look at recontracting, it's accretive to our portfolio.
Super. And I just wanted to ask Kamal, obviously from a wealth management perspective, is this impacting the way that you're perhaps looking at portfolios? You're getting any interesting questions from clients in relation to this?
Yeah, thank you, Matthew. And of course, thank you for having me as well on the panel. I think firstly, our message would be to not have a knee-jerk reaction in terms of selling down equities. So selling equities against this backdrop is likely to be a losing proposition, at least on a medium-term view. So that would be our message. But yeah, we're getting all sorts of interesting questions in relation to inflation and how that might impact, valuations of companies, and that tend to be where the questions are aimed at. So we're getting all sorts of interesting questions along those lines. We're looking to diversify further as we go into this new regime, if you like, and ensure that we have a broad spread of assets that can give us appropriate risk-adjusted returns through the cycle, to be as broad as possible there, Matthew, in my reply.
Okay. just, I mean, a couple of managers obviously touched on the whole issue of inflation and interest rates. Perhaps if I could just ask Tiago, I mean, is that affecting your outlook at all? Is that sort of giving you any concerns in your jurisdictions?
Yes, it is. It is. Before this crisis, we were already seeing some pockets of more persistent inflation, primarily in energy markets and also some basic commodity markets. And we believe that there is still support, at least in the short term, for higher inflation. Obviously, this new conflict can bring additional pressure to prices generally, particularly the commodities where Russia is a significant exporter. So that we should continue to watch how these specific markets, in particular energy, will impact global commodity prices. And I think there is a growing consensus on the need for monetary tightening, and this will certainly this has certainly been a theme that has driven returns in the markets recently. The expectations around interest rate hiking cycles. I think that bringing a bit of the regional context in LATAM, at least, there's quite a high number of major countries in the region that are seen to be ahead of their hiking cycles, ahead of the curve in their hiking cycles after quite aggressive interest rate hikes, trying to contain inflation. So arguably, there is a possibility that a large part of this monetary adjustment has been done in the major countries in the region. And if we see peaking inflation, we've started to see some signs of peaking inflation in the region. This was pre the Ukraine crisis. If we see peaking inflation, there is room for a potential easing cycle, which will certainly be supportive for these countries and for asset prices.
And do you think there's a risk that sort of any particular countries are perhaps overshooting with their interest rate rises at this point, or is that not much of a concern?
I think that there is a risk, at least in the short term. We are seeing that these interest rate hikes are taking a toll on the economic activity in these countries. We're seeing Mexico and Brazil going into technical recession, and certainly the outlook in 2022 is more challenging in terms of economic activity, so that there is this risk. But we'll see whether the LATAM banks were the LATAM central banks were right in preemptively hiking rates ahead of what seemed to be a very inflationary global environment.
I just wanted to ask Jerry. Obviously, your fund is very much about sort of long-term, stable, predictable income generation, as it were. Obviously, in a sort of rising or an environment of rising interest rates and inflation, obviously a lot of your power is sold through a lot of long-term PPAs, if I remember correctly. How protected against inflation are they?
Yeah, I would say, Matthew, when you look at our portfolio, a big part of it is that the expense side of the equation is very much hedged in many ways. So we have fixed long-term operations and maintenance contracts that have 5-10-year terms. We have property leases that have fixed prices on the sites. So a lot of the inflationary pressures are really coming through and impacting the upstream of renewables. And this applies globally. So if you think about steel prices rising dramatically, well, that goes into the racking for the solar projects, for obviously the towers for wind turbine generators. So that is having a real impact on developers. And just to give you an example, if your average solar project costs $1 a watt, just recently we've seen freight costs, as an example, go up from 2.5 cents to 5 cents. So that's 2.5%. Typically a developer, so more upstream, not where we're investing, but the folks that are securing the sites and developing projects, their margin may be on $1 a watt, 10 cents, and they have less capital exposed. They don't have the whole $1 a watt exposed, but you could quickly see their margin, their economics getting compressed. And so we're seeing a little bit in the market right now where developers, in many instances, are slowing down the pace, where they may have some projects that are shovel ready, but basically waiting and seeing to into 23, 24 to push out that inflation will subside. In some instances, these developers are going out and trying to renegotiate the revenue contracts that they will have negotiated. As it relates to what we do, we're typically either buying operating assets or construction stage assets. And so the current lay of the land is being factored into our analysis, and we're not exposed to many of those risks.
Okay, thank you. I suppose sort of related to that, you was obviously bringing up the sort of concept of effectively sort of supply chain issues. And I'm just wondering, both to perhaps Tiago and Dean, just looking at your portfolio, do you see perhaps, significant parts of the portfolio that could be affected, or companies that could be affected down the line, or is that sort of less of a concern? Perhaps I'll just push that to Dean first.
Sure. Well, the reality is virtually every sector of the economy is being impacted in one way or another by supply chain issues. So when you look at what's really driving this move in inflation, it's really been a combination of increased demand as well as constrained supply. So the supply chain is really being impacted quite significantly. But from our perspective, we have the ability in this portfolio to identify businesses, whether it's in financials, whether it's in energy, whether it's even in property, who are able to drive the top line, drive revenue, which is more than offsetting the increase in cost. So each one of these sectors is actually generating very robust earnings. And we really made this decision about a year ago when we concluded that inflation was going to be transitory for longer, when we concluded that the pandemic was likely to be easing over time and the economy would pick up. We just printed in Canada 6.7% annualized GDP growth. Bank of Canada yesterday just increased rates by 25 basis points. And we think those types of cost increases will be actually more than absorbed by what's happening on the top line. So I think you have to be identifying sectors. And fortunately, we have those sectors in Canada who are able to drive that top line growth, which we think is going to continue to drive earnings higher.
Okay, super, thank you. I guess we just move on. Obviously, there's been a sort of change, quite a dramatic change of administration in the US. And I just wanted to explore perhaps how this is affecting sort of each of your funds in sort of different ways. Perhaps if I could just ask Tiago first.
Sorry, Matthew. The question is on the changing regime in the US.
Yeah.
So we haven't seen any major change in terms of international relations after the changing regime in the US. The US remains an important partner for the region, in particular for Mexico, given the strong ties with Mexico. So we haven't seen a significant change in international policy. What what has been discussed since the change in Biden administration in focused on Mexico is there seemed to be a more benign and more open mindset with the current U.S. administration in terms of strengthening relations with Mexico, which is certainly positive for Mexico over the long term, and increases actually the scope for what has been called onshoring or nearshoring of trade relations, with Mexico being a major partner of North America. So I think there is with the change in administration, I would say there is a scope for a brighter outlook for countries like Mexico. No great change in international relations with other Latin countries such as Brazil and the Andean region.
Super. I mean, Kamal, have you got anything that you might add to that? Is it sort of affecting your asset allocation sort of decisions, or has that affected your asset allocation? Do you sort of see perhaps different opportunities going forward now that we've perhaps got a sort of different administration in the US?
Yeah, good question, Matthew. Generally speaking, we don't like to form long-term economic investments on the basis of political regime changes or that. In saying that, you know, we do monitor what international relations may imply for international trade. I mean, that's something we do look at a lot, but we haven't seen any significant regime changes that would warrant a wholesale investment change, for instance. That's a long way of saying no, but
okay, super, thank you. Perhaps Jerry, if I could just sort of ask you the same question. It feels a bit more pertinent in terms of perhaps what you're doing with your fund, just because there has been a big change in terms of outlook versus climate change and the sort of measures that the Biden administration is trying to sort of put in place. And you've got any comments you'd like to share with us on that?
Yeah, no, sure, Matthew. Yeah, clearly the Biden administration has made combating climate change as a central policy objective. And so, you know, in the early days in office, Biden has, you know, conducted a number of executive actions and for instance, has set the goal for the US power sector to be decarbonized by 2035. And so if you look back last year, the power production in the US was roughly 60% from thermal power generation. So, you know, it's just a huge undertaking. I mean, I would echo the sentiment that today renewables are economic on an unsubsidized basis. More and more corporations are seeking to decarbonize their operations. And so almost irrespective of the policy environment, renewables are going to continue to be the primary source of new generation in the US. And so, you know, overall, we're encouraged. And, you know, I would say, you know, in terms of tangible things the administration is doing, they have committed to decarbonizing the power for federal buildings, as an example, and it's just a massive opportunity. There have been estimates of, you know, potentially that would require about 10 billion of capex by 2030. So those are tangible things. I think the ability to permit, to facilitate permitting on federal lands for renewables is going to be improved. So those are all positive catalysts. But, you know, overall, again, we're seeing a run rate of 30 to 40 billion of new renewables a year. So in relation to what we're trying to achieve in the middle market of US renewables, in every conceivable scenario, we're going to be able to grow on a robust pace.
Okay, super. As well, sort of same question to you, Dean. Obviously, you know, North America, or the US being your sort of closest neighbor, as it were. And how has this sort of changed, I guess, your investment outlook? And how do you think that it's sort of affecting your companies?
Yeah, it is a good question as it relates to Canada, because we do have such a close relationship with the US. And as we discussed, we're a major source of hydrocarbon energy. And we also share the view that as we look forward, the future really is in renewables, and solar and wind have become very economic. And the way we frame it, however, which may be a little different, is that we truly believe that we're in a period of what we describe as an energy transition. Mm-hmm. And because we're still not quite there in terms of battery and storage technology, that at the end of the day, you can't solely rely on solar and wind today. You need to have other sources of electrical power generation, whether that be natural gas or whether that be nuclear. And we think that anyone in their portfolio, and governments even, should be actually modeling it out that way, because this transition is going to take next 10 to 20 years to fully play out as you watch renewables continue to gain market share. Mm-hmm. And Europe's probably the best example, and Germany in particular, which fully embraced wind and solar, which is great, but then abandoned nuclear and now is relying on natural gas coming out of Russia. We look at Canada being an abundant source of stable and secure supply of energy that we think will be valuable in bridging us to a more renewably oriented future some 10 to 20 years out.
Yeah, okay. Actually, sort of talking about that, really, it's probably a good opportunity just to ask the sort of question around ESG, really. So perhaps if I could just lead with you first, Dean. Sort of what is your ESG policy, and particularly operating in an environment that is sort of very much focused on sort of commodities, as it were, and sort of how does it work?
Sure. So ESG has, over the last 3 or 4 years in particular, become a core component of our investment decision-making process. In fact, in Canada, we have launched a number of sustainable focused funds. In fact, I've got a fundraising underway for a sustainable real estate fund, because buildings are a major source of CO2 emissions. So this is important to how we view and analyze investments at Middlefield. So we basically utilize third-party rating agencies. We have engagement with management. We look at and continue to impress on managements to improve their sustainability reports. We just hired a head of ESG at Middlefield, a fellow who was the head of the Canadian Coalition of Good Governance for 7 years here in Canada. He's one of the foremost experts on governance. We've just implemented a series of stewardship principles that follow the Canadian Coalition of Good Governance stewardship principles. We've just hired Glass Lewis as a proxy advisor to help with our ESG analysis. So it is integral in terms of how we analyze securities. So even in the energy sector, for example, we are trying to identify energy companies that are actually have a view on how they're going to be decarbonizing their business. So Canada is one of the world's leaders in the energy sector, oil and gas, in carbon capture and storage. So companies like Enbridge are allocating millions, tens of millions of dollars into those strategies. They're also investing in hydrogen strategies. You saw Chevron, a big US company, make a big renewable acquisition earlier this week. So we know that even legacy hydrocarbon businesses are making great strides. And we think in our ESG analysis, we can identify those businesses that will continue to improve their ESG principles of compliance over time. So over the last, as I say, 3 or 4 years, it's become integral to how we analyze securities and monitor those securities in our portfolios.
Thank you. Kamal, I presume this obviously is a very important part of what you do as well.
Yeah, thanks, Matthew. So from a fund selection point of view, which is obviously what I'm involved in, so we do run an ESG portfolio at Canaccord, and ultimately we're looking at 2 things. We're looking at whether the strategy is aligned with the UN sustainable goals, so that we'd like a strategy to be playing into one of those longer term themes. And we also like the strategy to be able to produce good performance returns as well. So it's a combination of what we're looking for. And some of the things that we want our managers to be assessing is exactly what Dean was just talking about just a minute ago. And importantly, it's about engagement as well. So we do like to see evidence of fund managers engaging with the end companies and evidence of them utilizing their vote in a good way, which can improve the company. So we don't take a sort of black and white approach to ESG as well. We are aware of the merits of impact investing and companies that are transitioning from being a dirty company, say, to being a clean company in the energy world. We don't want to cut off our noses as well. So we're aware of the different types of opportunities out there. So yeah, increasingly important for all wealth management firms. And as a firm, we're also signatory to the UN. We have recently adopted a top-down ESG policy as well from a business perspective. So it's everywhere and it's here to stay. Yeah.
Super, thank you. Tiago, have you sort of anything to add to that? I mean, how does that work out in your environment? Do you find sort of things like Kamal was talking about, the sort of engagement? Is that quite easy for you?
Sure. So at Aberdeen, ESG is integral to our investment philosophy and process. We have quite vast ESG resources. We fully integrate ESG analysis into our proprietary equity and debt research. We have dedicated ESG analysts that are part of investment teams. Also, investment analysts and managers are responsible for assessing companies and ranking companies based on ESG credentials and metrics. And we do have also a strong ESG central team, which gives us support for our stewardship actions. Historically, we had a strong. We've been quite active in engaging with companies, starting with the governance, but more and more becoming more aware of the ENS issues of companies and how companies and their activities have either positive or negative impacts on the ENS aspect, and we've been bulking up resources on those fronts, and we've set quite aggressive goals in terms of engaging with our companies, supporting our stewardship actions, because in the end of the day, we believe that ESG is not only the right thing to do, but we also see ESG as a way to create value to our portfolios and clients.
Super. I suppose related to that, I mean, my understanding is you've always been very strong at Aberdeen on the governance side, and obviously, as the whole ESG concept has evolved, you sort of build out the E and the S, as it were. Just to sort of come back to perhaps the governance or even the sort of full spectrum. In your sort of universe, do you find that there are sort of countries or jurisdictions that are just uninvestable on sort of ESG grounds?
We don't. Yeah, I think that there are some very, very specific regions that would be very hard to invest or justify for funds such as responsible investment funds, for example. What is happening in Russia at the moment, for example, I think will deem Russian assets, not only from a market functioning point of view, as hard to invest, but also from a responsible investing point of view. So that I think there are some examples of markets that would be deemed as uninvestable, but we do not have exclusion lists in most of our funds. Some of our funds, due to screening tools that are being SRI funds or responsible funds, they will have some sort of exclusion lists at the company levels. But we try not to have exclusion lists. We prefer to analyze the companies from the bottom up, not taking a view on the country from these ENS point of views specifically, and then ranking whether this company is a ESG laggard, a ESG leader, or an ESG improver. And we try to have ESG leaders in our portfolios, but we also see room to invest in both ESG laggards and improvers, and create a stewardship and an engagement agenda with these companies to try to improve their metrics.
Okay. Sort of just related to that, I mean, obviously you say you don't have specific blacklists, and obviously that acknowledges the fact that things can change. I mean, how much would you say a country's politics sort of affects your investment decisions?
So at for the Latin Income Fund, the fund is co-managed between our emerging markets debt team and our global emerging markets equity team. On the debt side, we mainly invest in sovereign debt, so politics play a big role in framing our investment decisions on the debt side. On the equity side, we are bottom-up investors, so we spend most of our time analyzing the companies that we invest, looking for the long-term winners and companies with strong moats, so pretty much stock picking. But we do monitor politics and macro in general, as they can have an influence on our holdings.
Super, thank you. I just wanted to come back to sort of Jerry on the ESG question again. Obviously, with the funds such as yours, you would tend to think that you've got the E quite nicely covered. But I just wanted to explore perhaps sort of what other things beyond the sort of obvious that perhaps you're doing with the E, and how perhaps the sort of S and G also figure into your calculations.
Sure, Matthew. We, we're a little bit different in that we're investing in private assets, and so it isn't as easy as going out to a third-party service provider and get a rating and check the box. So we actually began developing our ESG approach for private investments over 2 years ago. And, as we did the research, our parent company is a signatory to UNPRI, and we found many of our competitors were, but when you would, kind of peel it back a little bit, it was a lot of platitudes and nothing, substantive, when we were looking at this. So our investment team actually took the lead in putting together a proprietary ESG risk assessment framework. Our principles, we leverage the best practices, so from groups like SASB and others out there to form our policy. And so what we've created is both a quantitative and a qualitative risk assessment framework that deals with each of the E, S, and G. It is conducted prior to investment approval, and it's included as part of our investment memos that go to our investment committee. So there's a scoring, there's an analysis. It very much involves, integrated with our due diligence process, inquiries of service providers, of reviewing permitting, conducting phase one environmental site assessments and looking at the results of that, looking at governance, considering the impact of our projects on local communities, and we continue to refine it. So it's a continual approach on different deals. We learn new things, but we feel like it's worked well for us, and just quite frankly, has made us better investors.
Super, thank you. We've sort of got a bunch of questions sort of coming in from the sort of attendees, etc. And I'd perhaps just like to push some of these towards the sort of individual managers, as it were. The sort of first one I just wanted to ask Dean, it's a question that's come in. How easy is it to find income producing stocks in Canada?
It's actually a stock market that's actually got a number of businesses that are paying high levels of income. This is something that really was born out of Canada in the 90s. We had a unique vehicle called Income Trust that the government effectively converted into high yielding C Corps. So we've now got a yield on the Canadian market, which is actually higher than the US, actually lower than the UK, but reasonably high. We've seen a number of those businesses continue to bump dividends. So when we look at our investable universe, the financial sector are significant dividend payers. And as I say, that's over 30% of the Canadian market. The energy sector, which today is closer to about 15 to 20% of the Canadian market, as a result of more buoyant oil and gas prices, is actually now initiating and increasing dividends. And as I mentioned, the property sector in Canada, publicly listed REITs in Canada are yielding about 5% plus. And then we just have a number of industrials who may be a bit more mature in their business, and as a result have excess levels of free cash flow that they can pay out. So we actually have an abundance of companies here as a result of some of that history and kind of where we are in the market cycle that are actually paying very healthy dividends.
Super, thank you. We've got a question for Jerry here. How concerned are you about the increase in extreme weather events, and how can you mitigate the risks associated with this?
Sure, Matthew. Yeah, no, that's a real concern for us. And you could look, globally at severe weather events over the last year. One I would just highlight that is real for us are the wildfires that we've seen in California, and so. I would say as to how we mitigate it, we clearly consider it at the time that we're making the investments in terms of the environmental risks and the environmental impact. We're also considering that in where the project is sited and coming up with our long-term production forecast. So to give you an example, we have some assets in the Northeast in New England. For instance, Massachusetts, and looking at annual snowfall, and has that increased over time? And so we have soiling assumptions and assumptions around snowfall during the winter months. And so we have effectively a 24/7, 365-day year forecast that builds into our revenue forecast. The final thing I would say is just across our portfolio, the key risks are insured. So, whether it's weather events, a hurricane, wildfires, et cetera, we cover casualty insurance at full replacement cost, as well as business interruption insurance for that lost income. So the portfolios are completely insured. The one risk that we look at, though, is if these events are occurring more, are the insurance premiums going to go up over time? And so that's something we run sensitivities around and, clearly look at closely.
Okay, yeah, that makes sense. I mean, you were talking about sort of soiling there, sort of the panels. With the wildfires, was that something you actually saw more of? And you find you had to clean the panels more? And
exactly. And so there's always that decision, depending on the environment, whether or not, the rainfall, addresses it. But this summer, we did see an uptick in soiling. I would say, just to put it in perspective, perhaps 1% of production over a 2 or 3 month period. And our assets are hundreds of miles away from where the wildfires were occurring, but there was that residual impact, if you will. And not just the soiling, but it's also the cloud cover. So the irradiance isn't as strong with the poor air quality. So that's, kind of that combination.
Super, thank you. Question come in for Tiago. And it sort of almost seems with events the last week, you sort of forget that perhaps some of this has been going on. But the question is, which countries have been best able to manage the pandemic? And are there any jurisdictions that are more of a concern to you, or have been more of a concern to you?
Sure. So that's a good question. I think that looking back in the pandemic, the Latin countries and the population was severely impacted by the pandemic. Some countries where the health system is where the countries that count on a poorer health systems, such as some of the Andean countries in Peru, certainly took a stronger hit by the pandemic, and that was evident both in the number and the relative number of cases, as well as in the economic impact of those countries. I think that governments dealt differently with the crisis, taking Brazil and Mexico as the largest countries in the region. Brazil had one of the largest fiscal packages to support the Brazilian population during the pandemic, while Mexico took a more fiscal, austere approach to the pandemic. And it's worth highlighting that Mexican families benefited from record high levels of remittances from the US, which kind of offset the lack of fiscal response into emergency packages from the Mexican government. Now that we've gone through the worst, we actually see a quite positive outlook for the region, because LATAM has one of the highest levels of full vaccination. There is very high acceptance among the population. And when you look at the top 5 countries globally in terms of inoculation levels, the top 5 are all countries in LATAM. So the Omicron brought some concerns, but the low severity of the variants added to high levels of immunized population actually were a test to these countries, and so far we haven't seen any major impact to health systems and healthcare systems and these economies, and we're seeing signs of fading in this recent Omicron wave. So looking quite optimistic, I would say.
Okay, super. Got a sort of question that perhaps follows on nicely from that. Sort of somebody's said the IMF recently reduced its growth expectations for Mexico and Brazil. Do you agree with this, and how are you positioning your portfolio in light of this?
Yes, good question. We certainly acknowledge the macroeconomic risks for both Brazil and Mexico, as we discussed previously. The recent rounds of interest rate hikes, monetary policy that these countries are following is taking a toll on economic activity. So we do see growth as a potential issue going into 2022. There are also some uncertainties on the political front as Brazil goes into presidential elections this year. That said, although the outlook is uncertain and challenging from a economic activity perspective, we do believe that a lot of these risks are priced in, and valuations are looking quite attractive in both countries when you look both compared to historical levels and relative to other regions. So we have been able to find good opportunities despite the challenging macro outlook.
Okay, thanks. Super. Question here for Jerry, or sort of a couple of related questions. Obviously, Renew is a relatively small fund. Are there any plans to try and grow the fund anytime soon? And do you have any plans to branch out beyond solar and wind?
Sure. Yeah, no, absolutely. I mean, so we have fully invested the IPO proceeds within 10 months of the IPO. So the fund is now fully invested. Last year, with a view to continuing Renew's growth, we entered into a $65 million revolving credit facility, which was attractively priced at LIBOR plus 175 and 2%, which just really reinforces the high quality portfolio that we have. So we're now investing through the revolving credit facility And we have a significant pipeline of assets, solar and wind assets that are either that are committed under signed purchase agreements or under exclusivity. So we have a clear view on growth for the next several months, and expect, we're seeing good interest from our investors, and, opportunistically we'll continue to grow the fund. I mean, the opportunity in the US, even sticking within our footprint of the US middle market, is robust. And so it's billions of dollars of high quality opportunities that we'll pursue. In terms of technologies, the core of the fund will remain solar and wind. We do see more and more opportunities for solar plus storage. There's a lot of interesting things happening in the renewable sector right now. We've talked about green hydrogen, long duration batteries, et cetera. I think what we focus on, though, is just making sure that we could stick to our investment objective and deliver those sustainable dividends over time using proven technology and long-term contracted revenue.
Okay, super. Sort of thanks. Couple of questions here for sort of Dean. Somebody says that you've sort of got quite a large chunk of the portfolio in real estate. They're saying sort of around 30%. The sort of questions is related to that really are, why do you like the real estate, and how does it break down across the different areas? So commercial, residential, logistics, that kind of thing.
Sure, that's a good question, especially given the inflationary higher rate environment. It's somewhat counterintuitive for people. But in our view, we believe real estate is the single best equity income vehicle in the market. And we actually significantly increased our weighting to real estate about a year ago when we concluded, one, that interest rates were likely going higher, that inflation was in fact going to be more persistent than what central bankers were telling us, and the economy was generally opening up. And the reason we believe real estate made sense with that environment is that when you actually look back, say over the last 20 years, and we looked at the US market, and we looked at periods where, during that period when inflation was relatively low, i.e. sub 3%, and US REITs during that period did about 10.5 to 11% annualized return, slightly better than the S&P 500. And that was during a period where inflation was low and rates were declining. And then during periods where inflation was higher and rates were increasing, US REITs actually did over 17% annualized returns relative to about 12.5% for the S&P. So in fact, real estate actually did better during periods of higher inflation and higher rates. And it goes back to the point I made earlier, where if you just think about the nature of a real estate business, it's renewing somewhere between 10 and 20% of its leases every year. And if in fact the economy is going and growing, and in fact you are getting higher inflation and higher rates, so higher costs in your business, you're also able to renew your leases at higher levels. And that's more than offsetting the additional costs in your business. So it's actually improving the earnings and cash flow profile of your business, and driving stock prices higher. So when you look at where we're invested, we're actually seeing that right now within our real estate portfolio. So we're exposed to retail REITs, and in Canada, our REIT sector doesn't own any of these shopping malls, many of whom have been negatively impacted by the pandemic or this increase in e-commerce. Our retail REITs in Canada typically are necessity-based. They're anchored by grocery stores or by a Walmart. So they've actually performed very well through the pandemic, but because they were tainted by being retail brick and mortar oriented, they were trading at substantial discounts. So we've seen significant re-rating in that part of the portfolio. The other big weighting within our real estate component of the fund has been in industrial REITs. So these are REITs that are sheds that house logistics and distribution businesses, and they're clearly benefiting from this growth in e-commerce activity, which got a massive boost through the pandemic. And I think you're going to have a lot of entrenched buyers who now converted into more online shopping versus in-person shopping. And so the demand is there and the supply is constrained. So in an area where I live in Toronto, the Greater Toronto market is the second largest industrial real estate market in North America. And we're seeing releasing spreads over the last 6 months in this market that are somewhere between 20 and 30% higher than the previous lease that was in place. So again, it's benefiting from the strength in demand, constrained supply. And then the other major area where we've got exposure is in the multifamily space. So this is apartment REITs. And again, they were negatively impacted during the pandemic because people thought people were going to be vacating their apartments, moving to the country where they had a garden and work from home. When in fact, our apartment REITs through the pandemic enjoyed 98, 99% occupancy, 98, 99% rent collection. And what's really going to give it an additional boost here is that immigration in Canada continues to be quite strong. We're a population of 38 million people. We saw 400,000 new immigrants come into Canada in 21. We'll see somewhere between 410, 420,000 new immigrants come in 22. And typically, new people to Canada often rent for 5 or 6 years before they buy a home. So again, it's going to give additional demand for what's already a relatively limited supply of rental housing stock. So this is a sector that we're quite excited about. Even with higher rates ensuing here, we think the top line will continue to drive growth.
Super, thank you. I just wanted to bring Kamal back and ask, is this a sort of sector that you like? This is something that you're sort of focusing on for its inflation sort of proof income, if you like, in your portfolios?
Thanks, Matthew. Yeah, absolutely. We're looking at all sorts of areas that can provide a hedge against inflation. Obviously, areas that have some kind of exposure to hard assets are the clear areas that we should be focusing on. But you can get it in all sorts of areas. The investment trusts are clearly very, very compelling vehicles, not just because of the different types of exposure you can get, for example, across a liquidity spectrum, but they can also control their balance sheets in a way that open-ended funds can't. So they can reserve some income, for example, in the good years and smooth that dividend profile out in the harder years, as we saw throughout COVID. And they could potentially do this to hedge inflation as well. But yeah, so we are looking at all sorts of areas across the spectrum, and the investment trust space is an area where we're focusing on at the moment. Yeah.
Super. Thank you very much. I think we're about 55 minutes in now, so I've sort of got to wrap this up. But I'd just like to thank all of our panelists for joining today and basically giving us some really, really interesting discussions. Certainly know a lot more sort of about the Americas and obviously what's sort of going in that space and the interesting reasons where you might want to be sort of invested there. And also like to thank all of our attendees for joining today, and apologies once again for the sort of slightly chaotic start to this. But to say, if for any reason you weren't in quickly, all of the videos are sort of going to be available on our website. And as a sort of final point, if anybody's interested in these funds, I've posted a couple of links to some sort of presentations by our managers that are presenting today, and I would sort of warmly suggest that you have a look at those. So once again, thank you everybody, and I'd just like to encourage you all to come back next week when my colleague James Carthew will be posting our Asia Day. But once again, thank you all for joining. See you on the next one.